Today, we're diving deep into a really critical friction point in renewable energy finance. I'm talking about what happens when a brand new, super flexible federal market for tax credits runs smack into rigid, kind of outdated state systems. You see, the Inflation Reduction Act basically opened the floodgates for trading green credits, but as you're about to see, state compliance can feel like hitting a brick wall. For any professional in this space, figuring out how to navigate this conflict, well, it's everything. So here's how we're going to break it down. First, we'll take a quick look at the old world of tax equity just to set the stage. Then we'll get into the huge changes from the IRA, which, as it turns out, created a pretty big compliance gap at the state level. We're going to make this super real with a case study from Georgia, which will lead us right into a really smart hybrid strategy to monetize these credits. And finally, we'll wrap it all up with the critical risks you have to have on your radar. And make no mistake, the entire financial architecture for renewables is being rebuilt as we speak. This new idea of transferability has created this whole new universe of opportunity. But yeah, it's also laid a minefield of compliance challenges. For developers, for investors, the stakes for getting this right are just enormous. Okay, so to really get the revolution, we have to start with the old regime. For decades, solar financing was all about this concept called tax equity. And really, it was created to solve one basic problem. Solar developers, they generate these massive tax credits from their projects, but they often have little to no tax bill themselves to actually use them. So what do? Well, the solution involved creating these incredibly complex and, frankly, really expensive legal structures. You've probably heard of them: the partnership flip, the inverted lease, the sale leaseback. They were all designed to do one thing: bring in an outside investor who could use those tax benefits. So the bottom line is that tax equity was a workaround. A developer would team up with, say, a huge bank. The bank provides the upfront cash to get the project built, and in return, it gets the project's tax credits and depreciation to slash its own massive tax bill. I mean, it worked, but it was clunky and cumbersome. And that brings us to the Inflation Reduction Act, the IRA, which just completely blew up that old model. The IRA introduced a much more direct way to get to the cash, and it fundamentally changed the game. This right here, this is the code that changed everything. Internal Revenue Code Section 6418. This one little provision created for the first time on a huge federal scale direct transferability. It means a developer can now just sell their tax credits to someone else for cash. Simple as that. And the difference is just, it's night and day. We're moving away from months of legal paperwork and massive transaction fees. A Section 6418 transfer lets a developer treat the credit itself like an asset that can be sold. Legally, this is a massive shift. You're not selling a piece of a complicated partnership anymore, you're just selling an asset. But, of course, this new simplicity comes with new risks. And they've shifted. Under 6418, if that project fails or gets sold improperly in the first 5 years, the liability to pay back the credit, it falls on the buyer, the person who has no control over the project. On top of that, you can bet the IRS has anti-abuse rules to shut down any deals that look like they're just trying to artificially inflate a credit's value. Okay, so the federal government has created this fluid, really efficient national market for credits. But this is where our deep dive really gets interesting, because that federal fluidity is slamming head-on into a wall of state-level rigidity. And this right here is the heart of the problem we're looking at, a compliance gap. State tax systems, and especially their electronic forms and filing portals, were often designed years ago for totally different industries, like film production or land conservation. They just were not built for a world where solar credits can be bought and sold freely. So let's put this whole thing under a microscope. We're going to drill down into a perfect case study, the state of Georgia and its official tax credit transfer form, which is called IT Trans. Just look at this. This visual tells the whole story. When you log into the Georgia Tax Center to file the official IT Transform form, you get a drop-down menu, and your only options are for film or conservation credits. There's literally no code, and therefore no path for solar. It just doesn't exist. So you're probably asking, why isn't solar on the form? Well, it's because the state law that governs the credit, that's official code of Georgia Annotated Section 48-7-29.14, it explicitly forbids it. The law says a developer can carry the credit forward for 5 years, but it specifically prohibits a sale or transfer to anyone else, period. So what you end up with is what we call an administrative blockade. The state's own digital system enforces the non-transferability that's written in the law. A solar developer in Georgia who just sold their federal credit on the open market simply cannot do the same thing at the state level. The system literally will not let them.
So now you have a federal credit you can sell and a state credit you can't. How on earth do you optimize this bifurcated reality? Well, this is where the really sophisticated strategy comes into play.
You run two plays at once. It's called a twinning strategy, and you treat each credit stream totally independently. First, you use Section 6418 to sell that valuable federal investment tax credit, the ITC, into the liquid national market for cash. At the exact same time, for the state credit, you go back to the old playbook. You form a traditional tax equity partnership, but with a Georgia-based company that has a big local tax bill. Now listen up, because this next part is the whole key to the strategy. You are not selling or transferring the state credit, which the law says you can't do. You are allocating the tax attributes to a partner within the partnership. This distinction is absolutely crucial, legally speaking. It allows the value of that state credit to be monetized without ever touching that prohibited Form IT trends. It's a brilliant legal workaround. All right, so we've seen the problem and we've seen the solution. Let's land the plane here with the key compliance checkpoints and the big takeaways for any professionals trying to implement these strategies. This table really breaks it all down. Notice the mechanism for the old school flip, and our Georgia strategy is a K1 allocation, but the federal path is a direct sale for cash. And that one choice impacts everything, from the assets tax basis to your compliance with ERISA, that's the Employee Retirement Income Security Act, which, by the way, carries a much lower risk in a direct sale. And look, if you're going to do this, these are the codes you absolutely have to live by. For that state-level partnership, your allocations have to have substantial economic effect under IRC Section 704B. Basically, that means the deal has to be real economically, not just a tax move on paper. Super important. Even if you sell the federal credit, you still have to reduce your project's depreciable basis by 50% of that credit. That's under Section 50C. There's no getting around that. And finally, always watch your ERISA thresholds if you have any pension money in the deal. Which really leaves us with this final question. The federal government has created this dynamic, modern marketplace, but a lot of state systems are still stuck in the past. The most successful projects are going to be the ones whose financial structures, their capital stacks, are engineered from day one to operate in both of these worlds at the same time. The question you have to ask is yours?